To everyone. Okay, so when we say valuation, it means we always talk about fair market value, and when we say fair market value, it means it's a transaction price, guys. Transaction price. And when we say transaction price, so it means we are talking about buy and sell price. Let's say you have one property which is a plot, correct? So this person is holder of this property and now looking for a sell to Mr. B. The actual means as per buyer's expectation, because this guy is already a holder of this property, so his or her expectation is to get at least 10 lakhs, right? So let's say this guy also means as a buyer did some research and he or she got to know the actual price of this property is 8 lakhs, and this person will offer the same price. Look, you said 10 lakhs, fine, but as per my research, the actual price of this plot is 8 lakhs. So I am ready to pay you only 8 lakhs. So it means basically the buyer is willing to buy same assets at 8 lakhs. And if let's say this guy is, which is seller also, if agreed, if seller also agreed with this amount, which is 8 lakhs, then this becomes a fair market value. Fair market value. So that's what I said. In a valuation, everyone look for a guy's fair market value. All right. So apart from this fair market value, so you would see other values as well, like book value of the assets, book value of an assets, so when we say book value, it means, of course, I'm sure this person also would have purchased from someone else. Let's say this person, same A, paid 2 lakhs to acquire this plot. Alright, 2 lakhs to acquire this plot. So this actual price means this guy paid 2 lakhs, so this become your book value. Book value, right? And 8 lakhs, if you see, this is something market value. For the same property, the market value is which is 8 lakhs, or you can say fair market value, which is 8 lakhs. And see guys, both the prices are which are very important. It's not something that you can only record. Let's say I'll only record fair market value. No, both prices are very important. Now your question would be like, so look, why both are important? Now you tell me. Let's say you forgot to record book value of an assets in the books of account. So how will you perform accounting of that assets? How will you compute taxes? How will you compute the realized or unrealized whatever gain on that particular assets? Because the book value, which is something, it's a benchmark, right? It's a benchmark. So that always help us to compute the benefits or compute the realized and unrealized benefits of your assets. And that's when if you see, we always records two values, which is book value as well as fair market value. Book value and fair market value. So far, so when we say valuation, one thing that you can learn, one is fair market value. It means the value which is fair to everyone, buyer and seller both can afford, when both are, let's say, willing to exchange the securities or product at that price. So that becomes your fair market value. And this entire market is a game of fair market value. If, let's say, there is no fair market value available in the stock market, right? Let's say in market, if there is no fair value available in a market, then generally, you would see the rumors around like market is like overvalued. Overvalued, it means in terms of this transaction 10 lakhs, which is something overvalued. Again, 8 lakhs is also overvalued, but eventually buyer was ready to pay, and that's what this 8 lakhs converted into fair market value. Otherwise, this 8 lakhs was also, if you compare with the book value, because book value of the same asset is 2 lakhs and the fair market value which is 8 lakhs, but this 8 lakhs is also higher than the book value, so that you can still assume it as a book over value. But always we consider certain factors when we compute the asset prices. How, sir, we compute it? Let's say we have a plot, this plot which is in Pune, right? We have another plot again which is in Pune, and the same plot price which is at around 8.2 lakhs somewhere. So this is what we always you can say comparable inputs that you can say. So it means you can compare your 8 lakhs plot price with the other plots, and on the basis of that we take the decision. Let's say the other plot price which is at 10 lakhs and your product, let's say someone quoted or buyer is willing to pay which is at 8 lakhs, then you can say your product, it means this one which is at undervalued. So as a seller sold this product on discount of 2 lakhs. The reason is same plot, right? The other counterparty which is selling at 10 lakhs and you have sold at 8 lakhs. So in this case, you might be, seems like your property seems like undervalued, but the other counterparty's property, it seems like even overvalued as well. So it depends. But vice versa, let's say the other plot price which is at 10 and you're saying your price which is at 18 lakhs. So this becomes your overvalued. See, as a seller, if you again sell it out at 18, nothing like, you would be in profit. Undervalued, overvalued. See, all parameters which are not true, because that doesn't provide any exact the value and all. See, valuation is not something for exact to compute the valuation and all. It just give you a base how it should be the value of assets, different assets. It could be bonds, equities, or different financial assets. All right, so that just give you an insight, not exactly, but on the basis of that you can at least take some decision, and that's what the valuation come into picture. No rule or no technique can assure you, look, if you follow IRR or if you follow DCF, NPV or XYZ so and so, your valuation will be exact, and nothing like it, because ultimately we refer the input or data from the market sources. We refer the data, or your databases means your data is also based on certain inputs. So it means it's a possibility that if you again calculate through different rules or techniques, your valuation won't be exact valuation. So your exact valuation is, if you ask me, sir, what about my exact valuation? exact valuation transaction price, so which is a sales price. So again, to understand this exactly means what is this transaction price and my value. Let's say you have purchased iPhone 1 month back. You have purchased one iPhone 1 month back. Due to some XYZ reason, you have decided to sell this particular iPhone right now. You purchased at 1 lakh, and when you are trying to sell it out in market, the same product price which is at 80, but you are expecting that, look, I'm expecting at least 1 lakh because it's a new piece I just purchased, and now I'm looking for a sell. See, if you received 1 lakh, which is a good for you, but what if in your mind your price which is already said 1 lakh, but in reality the counterparties, or let's say buyer, who are ready to pay you only 80,000. So that 80,000 becomes your transaction price, sales price, and that sales price you can call it as a fair market value. And this fair market value would be your actual valuation of securities. Actual valuation of securities. All right. So let's discuss some other details as well. This was just a basic thing. That is, I just wanted to help you. What is an valuation? Valuation, it means value of certain financial instruments. All right. So let's talk about now the background work, so that we can discuss in detail. See guys, when we talk about valuation, few inputs is very important one. In terms of equity, let's say if I talk about equity, face value of the product is important, right? Book value of the product is important, and market value. Face value, it means at the time of registration, company just just split the shares or registered shares as per capital. As per capital, let's say very initially you have deposited 1 lakh as a paid up capital and decided to register at least 1000 shares. So per share price, just divide it 100 rupees. So this 100 would be your face value, and this value something which would be fixed. This value doesn't change with the market value. If a market value of your securities, let's say, it changes, but that value which is something fixed, and it's a base value of your organization. It's an initial value. It's a face, it means it's an initial value. When we registered the business, at that time we registered or report out 100 rupees, which is the face value of face value for core equities. Now let's talk about book value. Book value, it means as per the financial book. Financial book. When we say financial book, balance sheet, income statement, as per the balance sheets and income statement, let's say you have total assets just minus your liabilities and number of outstanding shares. So let's take the example. You have total assets. Total assets, it means we included let's say that initial capital we invested in different technology, human resources, or different strategies, and now we have generated some revenue, acquire some technology and all. So when we compute the value of total assets, let's say total assets value which is at 1,50,000, and total liabilities, it means payable of the business, long term, short term, whatever that you have, we have a 10,000. All right, divided by number of shares, we have total 1,000 shares. So let's calculate it now. 1,40,000, it would be around 140 rupees, which you can say it is your book value, guys. Right, it is your book value. See, this value never changes. This value changes. Value changes when assets and liability position changes or capital position changes. Did you get this? So this value is a very important. The book value of a company is so very important. Now your question would be like, so how we can compute book value of company? See, to compute the book value, it is mandate to prepare financial statements. So when we say financial statements, now we have two types of financial statements. One is consolidated financial statements and another one is standalone financial statements. So let's discuss about that as well. But your book value of per share is which is based on company's financial statements. So when we say financial statements, we have two types. One is standalone financial statements, consolidated financial statements. See, the difference is very simple. When we say standalone, let's say ABC Corp, right, has only one business line, which is telecom. ABC Corp has only one business line, which is telecom. So that becomes your standalone, because if they prepare financial statements, ABC Corp will prepare financial statements for a telecom business. That's all. That becomes your standalone business. That becomes your standalone business financial statement. So we have only one entity. In short, we have only one entity, and if we prepare financial statements for one entity, then that becomes your standalone financial statements. Let's say under ABC Corp, they have a different business lines: technical, oil, retail. All right. Just let's say RIL Group, Reliance Group, they have a different segments: finance, retail, telecom, oil, right? When Reliance prepare financial statements for each business line, as well as at the Reliance level, they also prepare consolidated statements, which is for all their sub entities or different business verticals and lines. So that statements become consolidated statements. That statements becomes your consolidated financial statements. So when we say consolidated, it means we prepare the financial statements, or we prepare the combined financial statements for all multiple business verticals. I hope you got this. It's a very critical, guys, because if you don't know the basics, then you can't understand the different aspects of a valuation also. And it's just a basic, it means it's a very basic, and that we should know it. Now, if you ask me, sir, which balance sheet or which, let's say, financial statements we should refer, standalone or consolidated? See, companies like Reliance Group, companies like, let's say, where is that? If company has a multiple products, listen this very carefully. If company has a multiple product or business lines, in that case, to calculate the book value of an assets, or let's say calculate the book value of for per shares, we always recommend to refer consolidated statements, which should be very accurate, to refer consolidated statement. So now your question would be like, sir, why, sir, we should refer consolidated? Let's say if you refer standalone, and if standalone business, see, standalone business in this case, let's say we have a multiple business lines, and if we prepare, let's say, standalone one, and see, every business prepares standalone and consolidated both. Standalone, if you refer standalone in case of this business, let's assume it's this retail business has a debt of 1000 crore, let's say 1000 crore, and loss is also reporting around 2000 crore, right? And this has been happening since last couple of quarters. But that loss, it will not reflected under standalone. The reason is, when we say standalone, it means they prepare, just on the basis of Reliance numbers. That's all. So entity wise details, you can't figure it out. And from a valuation perspective, what I means, my personal opinion, or in my knowledge, I would say, we always check the the value or debts or liabilities, whatever it is, or assets, we check for each entities. It means each entities, because all entities value, which is representing the Reliance value. What if something happened big with this retail firm? So we can't read that in a standalone statement, and that's what we always when we advise or consult any investors, we always recommend or request, please go through the consolidated financial statement, so that you can have a better understanding of business lines and their revenue streams, and then accordingly you can, whatever value that they have computed, means book value, so that value you can take it forward. Simple. Otherwise, if you don't refer it, if you just refer the standalones, so you might see the there is actually impact, means in the balance sheets, but you won't be able to figure it out. On other hand, if you have just one business line, let's take the example of let's say Idea, Vodafone, or maybe your Airtel, right? Let's say Demand. They have just one business line, which is retail. Correct. In that case, that doesn't make sense to check the consolidated statement, because they have only one business line. So you can refer this one for a single business line, to refer FS for single business line. Refer this for single business line. If you have just single business line, refer this out. So it's a very important. All right. Apart from this, two things are very important, guys. In India, at least, we have two different cycles. One is accounting cycle. One is accounting cycle that starts from 1st January to sorry, my bad. Sorry, 31st of December. So we have accounting year or cycle that you can say, because Indian market has two different cycles. One is accounting cycle and second one is financial assessment cycle. And that starts from 1st of April to 31st of March every year. So it means companies prepare financial statements on the basis of your financial assessment cycle. Now your question would be like, so look, why this assessment cycle? We have a different assessment cycle. See, just because of tax assessment cycle. We have tax assessment cycle which is from 1st of April to 31st of March, and that's the reason. So companies and even individuals, when we file taxes, we always refer the tax assessment cycle as a financial assessment cycle, and we compute the assets, liabilities, and update it in the books of account. All right. Now, maybe your question would be like, sir, why this is important? Look, if you don't know accounting cycle, if you don't know financial statement cycle, then how will you consider the input? If you prepare financial statements, then we prepare financial statements for quarter, for a month, for a year. But if you don't know, let's say, where to start, where to end, how that cycle works, then how will you collect the input? So when we say input, it means all key drivers of your financial statement. So when we say key drivers, it means your revenue, expenses, assets, liabilities, partners capital statement, equities, changes in equities, all that comes under key drivers. See, don't get confused. When we say drivers, it means factors. So those factors are required to prepare the financial statements. All right. And if you don't prepare the financial statements, then we won't be able to compute. See, if the business size is very small, if you count everything, if you count it on fingers, then you don't require any financial statements, to be very honest. And you can save your cost. It's a simple process that you can see your contribution, that would be your capital, assets, and the value of total assets at the moment, and expenses. That's all. But if you have hundreds of assets, hundreds of activities, then you need a proper statement which can help you to aggregate balances of all transactions on one statement, and through that one statement you can easily compute value, which is book value, and that book value you can compare with face value, you can compare with even market value also. I hope you got this, how financial statements it works. So let's now talk about one by one, so that we can have at the end will relate with this book value. All right, so let's talk about now balance sheet. See, balance sheet has two sides. One is your debit side, another one is credit side. But in balance sheets, we'll actually call it as assets and liability side. So we have basically assets and liabilities. All right. So here one thing that you would see interesting, which is every time we'll have an equation like assets is equal to liabilities plus capital, and that will equally tie. For example, let's say you have assets of 100, then liability maybe let's say 20, 80 you can see capital. So that will tie. And if this will tie, so it's a very difficult to understand, sir, how I can relate with practical life, because every time here would be like assets and liabilities, that would be same. So how can I relate this? So it's very difficult for me. All right. So that would be questions in everybody's minds. So how we can understand this? See, it's a very simple. When we raise capital, so let's say you have started one ABC Corp, and you have decided to invest 100 rupees in that particular business. So now let's talk about balance sheet. Balance sheet, again we have two types of balance sheets. One is vertical balance sheets, right, and another one is horizontal balance sheets. In a horizontal you would see T shape, right? This becomes your horizontal and this is your vertical, and in corporate or everywhere we follow the vertical only. So in a vertical you would see total assets would be up, total assets. See, now if assumption is if you invest 100 rupees in ABC Corp, the scenario would be capital, because your cash business will treat as a capital, correct, which is 100. So basically ABC Corp has received capital of 100 from, let's say, Mr. A. We'll report that out. But when we received capital, let's understand, I won't be able to cover entire accounting entries because this is not for accounting, it's for valuation. So we are trying to understand the linking of rule. So I'll just decode one accounting entry over here. So if you see the first accounting entry, when we received capital in the business account, it would be like cash account. Hold on. Yeah. Just hold for a moment because it got hanged up. Okay. Cash account debit to capital account credit. See, capital, again it would be your credit balance and we have already recorded. But what about cash? We have received 100 rupees cash as well. So capital we have recorded to the credit side, and assets always we record to the debit side. So it means under assets we need to record cash, and cash balance that we record as a positive balance. So now in short, at this level, if you just compute or if you just try to set this, or let's say as per this rule, if you just apply it, it's a very simple capital, whatever that you have received, right? So that capital, it's your assets which is available in the bank's account, and that cash which is belongs to your capital. So basically this assets, because cash is the part of assets has been generated from the capital. Simple. You have raised capital, right? So through that capital only we have received cash, correct? And cash is the part of assets. And that's when, if you see, whatever cash that you have received, that cash is the part of your capital, and capital which is something your book, or you can say initial value that we report. Because when we report the capital, we hardly change that capital, because if you want to just increase and decrease the capital, in that case only you can see the change in capital. Otherwise we don't change this capital at all. Why we don't change it? It's a benchmark, guys, that we have raised 100 rupees and we have available 100 rupees in the books of company as well. And that's when, if you see, now we have a debit is equal to credit. So it means total assets is equal to liabilities plus capital. So in this context, we don't have a liability. So total we have 100 of rupees assets. 100 of rupees assets. Correct? And it is time. Right? And as per this calculation, see, it's the initial calculation, right? And as per this calculation, if we just calculate the face value, let's calculate the face value. Total assets, which is 100, and total capital, or maybe vice versa. Let's say you have total capital of 100 and total shares that you have, which is 10, which you have decided. So calculate the value. It would be around 10 rupees per shares, and this is your face value. This is your face value, right? Let's say up to 1 month, what happened? Up to 1 month, business has incurred some liabilities, or you can say business had invested this cash into stocks, and the stocks value is 100, and let's say on this particular stocks there is an unrealized gain. Unrealized gain of 20 rupees. Right? See, I haven't changed the capital, but the circumstances is whatever capital that we have raised, we have invested that capital in a stock, and that stock now which is appreciated by 20%. So it means we have 20% as an unrealized gain on stock investment. So now when we compute total assets, whatever that you have, let's compute it. Total assets include cash plus investments, whatever that you have. So now we don't have a cash because cash we have utilized to buy this particular asset. So it means we have investments and plus unrealized gain, that all will consider together. So total assets, which is 120, right? Total assets we have 120 minus liabilities. We don't have any liabilities as such, and capital which we have is 100. So but here the equation is not time. So why equation is not time? Because one thing that we'll have to adjust now. If we have unrealized gain which is 20, so you can add that gain as maybe retained earning, or if it is not realized, so you can add as it is, which is unrealized gain, and that is something 20. Because profit and loss that we always see, if we have a profit, we always record profit to the credit side, right? Because capital and profit all we record to the credit side, and now if you add your profit as it is to the credit side, we have now 120, and if you see total 120 which will tie. So total capital is equal to your assets. So your capital has appreciated by 20%. So now if you read this in an equation, and if you ask me, sir, how will you read to this? See, now I'll read in a way. See, my capital was 100, which is a book value, and 20 which I got the appreciation. When I compare with market value, so 20 rupees which is extra which I can see, and that is something market value of my investment, because capital value would be remain same, and that's when my analysis or your ratio or value analysis will come into picture, because we have the face value which is reported, and that value will compare with the book value. And if you calculate the book value now, 120 divided by 10, so it would be around 12 rupees, which should be your book value of assets. See, trust me, this is your actual value. So when you invest in any companies, you should bother about this value. Now your question would be again, sir, why I should bother about actual means this book value? See guys, so book value which will provide you the real insight of a business. So it means how much assets that the business is holding, how much cash is available in the books of company, let's say how much investment has business made in throughout that particular financial year, how much profit that it will realize in near term. So that all details your book value ratio will represent it, or book value price per share will represent it. For investing, we don't check any face value, to be very honest. We don't check face value. We check the book value of an assets, or book value of an liabilities, or book value, I would say book value of a business. And here in this case, we have a book value of a business is 12 rupees. So let's go ahead further and see. Let's say up to one month or 2 months, what happened? We have incurred some staff salary or other penalties, I would say, but we have just received it and we haven't confirmed it to the or processed it out. We have just incurred it, right? So in that case, it would be like your liabilities. Liabilities we have around 5 rupees, right? So now in this case, we have a liability also, and liability always we record to the credit side. Now, what if, let's take the hypothetical example. As per book value, so your value of share, it should be like 120 minus 5 divided by 10. So it should around somewhere, let's calculate, 115 divided by 10, around 115 rupees. So actual value, it should 11.5 rupees, right? And this is become your actual value. Why? The reason is we have now added liabilities. But let's say in a market, same stock which is trading at 12, same stock which is trading at 12. Understand this first. As per balance sheet or as per financial statement, the stock price which is at L1.5, right? But in the market, let's say on a market screen, this is your market screen. Let's say your stock is trading like this. So somewhere here, trading. So it means in market, same stock price trading at 12. So this has become your market price of a stock, correct? quarter 6. But as per the book value price, which is at somewhere here. So as per book value, stock price, it should be around L1.5. See guys, this is the case where we'll always say it's a overvalued stock. This is what we'll say it's a overvalued stock. Why? Because in market price, which is at 12.5, and as per the financial statements or book, the price which is at L1.5. So this situation becomes your overvalued of a stock. And let me tell you something. See, again, it's not a true. I don't want to get into any arguments because everyone will have a different opinion. See, we do not invest in overvalued stocks. Why? Because this 0.5 difference, that if you see, this difference is generated because of maybe trading volume or demand and supply force. So eventually, if there is no actual value in the balance sheet, so you might see this particular stock price will get it, means it will goes down in coming time. But again, it's just an argument. It's not something which will apply to the every stock or something. It's kind of a universal law. That's what I said. In a stock market, nothing is fixed. It's just ifs and buts. You can just see how you can apply your logic or and see if you can figure it out something. But it's not something, okay, in my course or told me overvalued stock we cannot buy it. No, it's not true. It's not true. I'll decode that as well at the end, means this terminology explanation. I'll explain that also. So one is the as per if the stock is overvalued, do not invest. Why? The reason is, so you might see speculation in price or any pump and dump. So someone have, let's say, deliberately pumped it, so you might say dump it. So that happened because eventually the point is there is no value in a book of a company. So why there is appreciation or premium that we should pay, right? Because if you are paying premium, then it means you are ready to take a risk, because if something happened with that particular stock, see, company is not responsible for a market price. Understand this. Company is not responsible for a market price. Let's say as per book value of a stock is 100 and stock trading at 500. And if something happened with the company is entitled for only 100 rupees. Because company has 100 in the books of account, company will sell it out assets and get that amount. That's all. So it's not something that company will pay your market value if you purchase anything. No, company will not purchase anything as such. All right. So one thing that you can understand here, if the stock is overvalued, be cautious. Now, see, the argument that I have discussed, do not invest if any stock is overvalued. But there are few exceptions. Let's say if stock is penny stock, stock is like stock is like small company. It's a very small company. And let's say industry is also now facing some problems. Or we have, let's say, maybe economy also, which is at a very slow down stage. in this context, please be very very cautious and avoid to invest in overvalued stocks. The reason is, overvalued stocks, it may come down at any point in time, right? Again, which is not true, but so it's a clear indication that if something happened, let's say if it is a penny stocks, then there would be no potential in the business, correct? If it is a small company, always, small company stocks we easily manipulate, means as a big investors or institutional investors, they easily manipulate, and we don't have an input, exact input, and that's what price is overvalued, right? And if industry or economy, let's say if we talk about few years back, the government PSU sector was facing some problems, but now PSU sector is in limelight. Then few years back, the banking sector was facing some problems, but now banking sector is on track. See, and now let's say if we talk about other industries like agriculture industries and also, we don't see much of things in agriculture sector, though it's a very promising sector, but due to some the restrictions, and farmers are very like sensitive topic and so things, you would see, in that case we do not recommend to invest. But on other hand, let's say the stock is overvalued, but this particular company has a solid cash flow in place, positive cash flow, they have a good payables and receivables system, like very quickly the receivables will convert into cash, which you can say payable or receivable conversion, quick conversion cycle. On other hand, you can also think about if the business has a unique model, industry is growing, economy is also growing. In that context, even if the stock price which is at overvalued, still investors, they'll prefer to buy it out. Why? The reason is, there is a momentum just because of economy, there is a momentum just because of industry is experiencing new high or growth, and maybe it's a possibility that if company has a huge positive cash flow, or if the company which is, let's say, which is at a very solid stage, like large cap or mid cap companies, in that case, even if the stock price or let's say stocks are overvalued, still in that case also you can buy and invest. So latest example, if you ask me, the government's defense stocks, most of the government's defense stocks, they are like overvalued now, but still I have purchased it out. I have made a profit of 1 lakh rupees in last just couple of days in the government defense sector company. Same for railway companies as well. Most of the railway companies, they are like overvalued, but that's fine. I'm anticipating something big in budget. Maybe government can increase the spending limit of railway sector, and that benefit directly goes to the railway companies. So it means railway companies profit or revenue, it will goes high, and it's something, if you invest in those companies, and even if this stock price which is at a higher level or overvalued, if you compare with the book value, still you can invest. So I hope you got all the arguments, right? All right, so now let's talk about some undervalued stocks. So when we say undervalued, same example, let's say, as per the book value, right? As per the book value, so actual book value, which is at L1.5, but let's say in a market price, which we have something different in market. Let's say price which is at here, due to maybe sometime demand and supply or market sentiments, maybe market crash, so on and so forth, and price which is at this level. See, as per book value, price, it's price means as per company's book value, price which is at L1.5 rupees per shares, but as per the market value, price which is at 11 rupees. So here you can see discount. If you purchase at L1, right? Because as per the company's balance sheet, stock price which is at 11.5. So you can see actually discount on stock price which is 0.5, and this is what we'll say which is undervalued situation. Undervalued stocks. In terms of undervalued, see this again situation you cannot apply it to all. If let's say industry is growing, economy is also growing, and we have a healthy political competition, or I would say stability and all, and also let's say company has a healthy cash flow, business line, good clients, growth. If you see your revenue, everything means which is like expenses and everything which is in control, then in that case, if the stock is overvalued, then most of the investors sees factor always applies, means revenue, industry, company, politics, geopolitical issues, that always applies. That would be there in the background, so that you need to figure it out at that time only. So in that case, undervalued stocks would be best for investments. Buy those stocks. Definitely you may see the profit in future. Why? The reason is they have a solid investment background, which you can say which is as per the financial statements, their value which is at 11.5. So we should target that price. Means definitely you will get the price very soon. Because few days back, what happened on, I believe, the result of Lok Sabha, I was there. I was doing trading on that day, because it was an opportunity for traders. I was doing trading. What happened? Stock price suddenly, when stock market crashed, every stock was like in a huge red, like 20%, 15%, especially government PSU stocks. They were in a huge red zone. I was also cautious, and before the Lok Sabha, the result only, I booked the profit around 2 to 3 lakhs. I don't wanted to take a risk and release my all the capitals, 80% capital, and rest capital I had invested in the non-government entities, just to be very safe. I just wanted to play safe. All right. So now if you see, in case of undervalued, you can if you see any opportunity as such, crashes as such, always quickly verify those stocks, because it was an opportunity, and picked up. And I did the same thing. See, when the market crashed, I purchased around stocks worth of rupees 8 to 9 lakhs, and very next week I have seen the big boom, and again I booked the profit of 2 to 3 2.5 lakhs, right? So this is how your actual, means along with the market factors, your undervalued and overvalued stocks, which works in a practicality. And if you guys are like quickly able to understand like which stock is undervalued, which stocks is overvalued, then accordingly you can take the investment decision. But let me tell you something, this undervalued concept you cannot apply to all. What if, let's say, stock is undervalued but industry's growth is very low? Let's say industry growth, it means, let's take the example of IT. In IT sector, we haven't seen growth much in last 1 and 2 years. Revenue or clients booking, we haven't seen much growth. But on other hand, we have seen growth in semiconductor industry or sector. We have seen growth in solar. We have seen growth in AI. Right? If any company has or have adopted AI, definitely they have delivered solid returns to their the financial results and all. In that case, if industry is, let's say, not growing, economic condition is not good, and that stock is undervalued, then do not invest. The reason is, even if it is undervalued, see, the industries and the economy both are facing problems. See, your economy is like a grandfather, industry is like a father, and company is like a child. See, if a company is in problem and if industry has a favorable, factors or policies, then definitely that company will grow it. If let's say industry has a problem but the economy which is at a very solid stage, then definitely you would see, economy will help industry to survive. And the sabka baap, like politicians, if let's say political stability, if you see, because before the election result only, I disclosed the list of my favorite stocks like hal, Mazga dog, means defense, railway. I was very bullish on infrastructure, 3 sectors, and renewable, 4 sectors. Almost 20 stocks list I published on my YouTube channel as well as on my social accounts as well. And at the time only, I stated one comment like, the most of the investors, especially, see, I am not a opposition, so my views can be different from investing perspective. So I stated, as an investor, this NDA government seems like more promising and committed, and that's what investor has more trust on them. So if you see, in a 2 days time, means on election days, when the investor got to know that BJP has no majority, market was crashed with 14 lakhs crore value. So it means Narendra Modi has a value of 14 lakhs crore. See this, and it's happened. See, I'm not saying that market will ruin and everything will disrupt. Nothing like it. For some time you would see hiccups, but again market will recover. Some of the other day you would see big boom in market. Ultimately, you would see political factors which are not permanent factors, right? If today we have a Narendra Modi, what if tomorrow he is not there? Maybe someone will come and design some policies around it, work in this and that will happen. You would see hiccups, that will be there, but we are in a democratic nation. But yes, so my point is that political events, economical events, and industries growth or other events, that will definitely affects on your stocks. And that's the reason, always check at least 3 things: political situation or geopolitical issues, that's the one. Second, industry growth, search it on Google, that will give you a number, right? Means at least 3 to 4 years growth, you can check it. And third thing is economy, are we growing, or means in terms of GDP, you can say, if the GDP is growing, if the GDP is in green numbers, just read this. All right, so just go through this, and then after, of course, the last thing would be, you can review the financial statement of a companies and check it, the book value, compare that book value with the market price. Where you can refer the market price? Of course, you can refer the market price from the actual, you can refer the market price from the chart, NSE, BSE, and compare that, and then take the decision. So this is what your overvalued and undervalued as well as market value of a stocks works. But guys, in most of the cases, market value generated from the force, which is buy and sell force, or you can say demand and supply force. What if supply of a securities which is very high in the market, but there is no enough demand, then definitely price will goes down, maybe below the book value of a company also. That also happened, correct? What if the company is very solid, but supply of a shares which is very high, and that's what price drop in the market? Company can't control it. But in that case, as a promoter of the company, they'll design